Hey, what's up, everybody? This is Ray Lucia Jr.
And I'm Joe Lucia.
And we are Lucia Capital Group, and this is the Managing Your Financial Future podcast. And today, Joe, we're going to talk about a top fear that retirees have.
Actually, Ray, here's the stat. 72% of retirees say going bankrupt due to long-term care costs is their number one concern.
And most people are afraid to even talk about long-term care insurance and coverage and how they're going to fund it because it's one of those things you don't really want to think about.
And, take a look at our parents. I'm hopeful that they've done good financial planning and they have their long-term care policy, because what kind of stress does that put on you and I and our siblings to take care of them in the future?
Yeah, especially, when I'm thinking about my parents, my in-laws, and obviously my siblings. That could be a big number for us to figure out who splits it up and if the planning wasn't done properly.
Well, we know firsthand our grandfather is going to be 93 and he's in a long-term care memory facility, and the costs there are, I think, $8,000 to $10,000 a month.
Yeah, and I'm not privy to the discussions amongst the aunts and uncles about all that, but my impression is it's been pretty taxing on them, relationship wise, and financials. We talked in the past. Fortunately, Grandpa had a nice pension and stuff like that. But regardless, it's certainly top of mind for 72% of retirees out there.
So, Ray, the fears might not be as bad as you think, because there are solutions, and having good, sound financial advice and looking at some of those solutions may mean the difference of a goose egg in your portfolio or being able to sustain a lifetime of income.
Yeah, you're right, Joe. And a lot of people are fearful about long-term care insurance and the monthly premiums and how much it costs and whether that might even bankrupt them before they even get to needing long-term care. But there are solutions out there that most people, quite frankly, haven't even heard of. And there's solutions that, when used properly in coordination with a financial advisor in your financial plan, that you can feel good about managing this top concern.
With that, Ray, let's turn it over to the guys and let them give us some potential solutions. Take it away, Johnny Dean and Rick the Professor Plum.
It's been almost 2 decades we've been on this journey to educate, liberate, and help you take action so you may better manage your financial future, achieve peace of mind, and accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you set your goals and guide you along the way to help you achieve them. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. I'm your host, Johnny Dean, with our own Rick the Professor Plum, Chief Financial Planning Officer. It is called Managing Your Financial Future. It's what we do here on this podcast. I'm Johnny Dean here from Lucia Capital Group. Professor Rick Plum joins me here. Also, oddly, coincidentally enough, from Lucia Capital Group. Rick, certified financial planner, and what are you, chief planner? What's that title we gave you?
Chief bottle washer.
That's what it is. Head of financial planning.
Chief financial planning officer.
That's what it was. I knew it was chief something. Anyway, you're here with me to talk a little bit about some of this stuff. This came up. What Ray was talking about, this came up, 4 or 5 weeks ago, something like that, a few podcasts back. And we had some questions on this, and so a couple anyway. So we thought we would devote a little bit more time to it. And it has to do with this whole idea of long-term care. What we talked about in that previous episode was what happens if you live too long, die too soon, or get sick along the way. I think it's something like that.
Right.
And we talked about some of the insurance products, and it was insurance, but the getting sick along the way, something that I had mentioned and you talked about briefly, was that people just don't like buying things like long-term care insurance.
Well, it's not a guaranteed need. I mean, we all know that at some point we're going to die.
Yeah, I've heard that.
So we can kind of rationalize the death benefit if somebody actually needs us.
Oh, sure.
Financially.
And you don't really have to convince too many people that it's a good thing, especially if they have a family.
If there's a financial need, you can see it. But the financial need for long-term care is a little bit different because it's usually in the future. It's something that's not normally 100% guaranteed in your lifetime. And so it's for retirees, we talked about this in the last, at that podcast you were talking about, it's a cash flow item. It's tough. I mean, we're trying to retire with a certain amount of income, and we're trying to fit our expenses into the income that we can create from our portfolio, Social Security's, pensions if we've got them. And we don't have a lot of wiggle room. I mean, fixed income for the seniors. I mean, that's what they'll talk about. Adding another expense is not always fun.
It's never fun, especially since you don't really get anything out of it, at least not right now. But that's the attitude.
But unfortunately, it can be a very necessary issue. I mean, okay, for a lot of people, it's protecting their net worth for their heirs.
That's it.
And so some people can say, well, I'm protecting my net worth for me. And if the heirs get what they get, they get what they get. If they don't get anything, well, they're on their own at that point. But sometimes the heir, it takes a step higher on the ladder, and it's a surviving spouse that we really do want to care for, and the two of us built this net worth, and we want to protect it for that spouse, or even for us if the spouse goes into a situation and it adds another $60,000, $70,000, $80,000 to our annual need going into a long-term care. Where's the money going to come from if we don't have insurance? It comes from our portfolio. We draw down the portfolio, caring for them for a year or two or three, and now they pass away. We lose the Social Security benefit, we have less income, and we have a significantly lower amount of portfolio. So insuring that portfolio for that surviving spouse is a much more important issue than just survive. So I think married couples need to look at it a little bit differently.
Well, it does. And you didn't even mention the toll that it takes on somebody who may have to quit their job or go down to part-time to take care of a spouse who's ailing.
Right. And just the physical toll, too.
The physical toll it's bad. And I've known people who've had to do this, and it gets old, if I could say that, very, very quickly.
And that's where we see a lot of people coming in, and they're proactive about looking into long-term care alternatives, options, how do you do it, things. People who have watch their parents go through it, or their aunt and uncle, their family members.
Absolutely.
They're saying, you know what, A, it's in my family, and B, I don't want to do this.
So, but what I think is interesting, though, do you see this where people say, yeah, I recognize the need. Yeah, I really need to take care of things like long-term care, but I'll do it tomorrow.
I don't know if it's so much of I'll do it tomorrow is, you know what, I really want to retire, and it takes my entire portfolio. I don't even know if I have enough money to retire using my portfolio to provide all the income that I need to retire. How am I going to either create more income to pay a monthly premium, annual premium, or carve off a piece of it? That's usually where I see, that's just my views of this. This is what I see people, why they postpone it.
So I'm getting rid of $3-4 grand a year, and it can be much higher the older you are, but let's say it's $3 or $4 grand a year, maybe $5 if you have a couple, if you have two people, and they're saying, I may never even need this.
Yeah.
In 10 years, I've spent $50,000, handed it over to an insurance company, and maybe I'll never need it.
And at that late, I may be only 70 or 75 years old, and I probably won't need it yet. And so it's probably more like I'm spending this $5 grand for 20 years.
It could be, and never.
That $100 grand could be invested, or that $5 grand a year could be invested, and I'll be able to pay my own long-term care. No. When it comes to the actual costs, it's very difficult to invest the premium and earn a rate of return high enough to get the same benefit you'd get back from a long-term care insurance policy. But there comes the uncertainty. It's not 100% guaranteed to be needed.
No, it isn't. That's the nature of insurance. I have car insurance, and I don't know that I'll ever
I hope I don't use it.
Fire insurance.
I hope I don't use that.
I hope I don't use that, but I've got it. So anyway, the insurance company recognizes this, and they recognize too that people who buy even the people who buy long-term care insurance, just the regular standard policy where you hand it over to the company, and eventually, if you need it, they're going to pay it out to you. Those premiums can go up. They're not level term like a level term insurance.
They're not guaranteed
policy.
Level for the rest of your life.
No,
they do try, and they did base them on what at the time these policies purchased 10, 15, 20 years ago. They thought that these would be level for as long as the person lived, but they miscalculated.
Well, because the cost of care has gone up so much. So you got to get creative. The insurance companies did so, and they came up with this whole idea of linked benefit. We've actually talked to one of the people who was one of the original
fathers, so to speak.
Designers. We've had him on the show before, a guy by the name of Gene, and he had talked about how the insurance company was recognizing these trends. People were not wanting to buy it. They couldn't sell these policies, so they came up with something called linked benefit. And I find this to be really interesting. It's called linked benefit, Professor, because it's kind of linking a life insurance policy
or an annuity.
Or an annuity. You can do it on the annuity side too. That's true.
So you're
to a long-term care policy.
You're taking another product, an investment product in some respects, or another product that is issued by an insurance policy, and putting a rider on it to enhance it in the event of long-term care.
You're kind of, in the case of the insurance policy version of this, you're really borrowing, or not borrowing, you're using the death benefit that would have gone to your heirs. You're taking it while you're still alive and using it for long-term care.
And extending it past the death benefit.
Yeah, so let's talk about how this works.
Well, with a life insurance linked benefit, you take a certain amount of cash. They're generally done on a single premium. They don't have to be. You can do them over multiple years. You can pay into them, but generally they're done with a single premium. You have a CD or money that's kind of emergency money you have setting off the side. Maybe it's $50,000-$75,000, and you say, I don't think I'm ever going to need that, but it's not earning very much. I mean, it's earning a couple percent here and there, but is there a way I can better utilize that money to maybe cover two birds with one stone? How do you want to say it? I don't want to kill anything.
Well, let's take this. Let's say it's $50,000, okay? And I'm 65, and I've got $50,000 just sitting there. I don't like the idea of buying long-term care. I know I need it, but
I don't want to increase my cash flow or have to increase my expenses. So you take that $50,000, you qualify. You have to be healthy enough to qualify for insurance. You get a life insurance policy. Maybe the death benefit's $80,000 or $90,000. It's not a huge death benefit, but I put the 50 in. I've got $80,000 or $90,000 of death benefit. The key thing here is if I need my 50, I can get my 50.
That's where the big point is right there. I am not handing $50,000 over to an insurance company with a single premium payment and saying, well, when I die, pay my heirs $90,000 or whatever the benefit is. I actually still own this $50,000. I have ownership of this $50,000. Maybe not all of it in the first few years. There's maybe a surrender period.
Probably.
Who knows? But let's just say after a few years, I can access this money completely,
just like I could have before, with the exception of that surrender charge the first couple of years.
So what am I doing? I'm taking this $50,000 that was in a CD at XYZ Bank, and I'm going to move it to XYZ Insurance Company.
So the insurance company now says, okay, you've got $50,000 cash on file for you, on account. You can have it back. It's going to pay a little bit of interest. Don't expect very much. If you die, there's $80,000, $90,000 of death benefit. Now, if you don't need the cash and you haven't died yet, but you need to have long-term care coverage, you go into a facility, you have certain home health care needs, you qualify. They talk about activities of daily living. You trigger 2 of the 6 activities of daily living. You qualify for the payment. They'll say that, okay, you now have $180,000 of long-term care protection. And so we're going to start sending you out $180,000. Now it's not all in lump sum. It's not. It may be spent over 4 or 5 years. So that's all the differences in the policies. But so you could get $40,000 or $50,000 a year maybe in coverage and help to pay for your long-term care over the next 3, 4, 5 years.
So if I go into a facility, I'm now 80 or something like that. I don't even know, but I go into a facility and let's say it's costing 40, 50, or maybe even a little more.
Let's say it's $50,000 a year. That CD would have gotten you 1 year.
And that money would have been gone at that point. Nobody would have gotten
the long-term care coverage would probably get you 3 years.
3 years. All right, 3 years. What's the average stay at a nursing home?
2.5 to 3 years.
Assuming that's what it is, 2.5 to 3 years. But even if you stay longer, you have to dip into your portfolio.
You don't dip into it anywhere near as soon. I mean, and try to get $50,000 to grow to $150,000 in the rest of your lifetime. I mean, it's not easy to do. So at that point, you're 65-ish years old or so. With this $50,000, only 3 outcomes that could happen. You need the cash. Well, subject to the surrender charges, you can have the cash. You don't need the cash, and you don't need long-term care, and you die. I mean, if you don't need the cash, and you need at some point, you're going to die. Well, your heirs get the $80,000, $90,000, whatever the death benefit was. Or you don't need the cash, but you need long-term care. Now you've got the long-term care coverage that's going to draw down. Now, the first money that's coming out, the first $80,000, $90,000 that's coming out is coming for the death benefit.
Of course.
And if you've pulled $100,000 out of it and you're still in a nursing home and you're still pulling money out, when you die, there's not death benefit left. Maybe there's a $10,000 residual to the family, but it's not going to be a huge $80,000 and the long-term care over and above that forever.
Now, because it's an insurance policy, the tax consequences of taking this money and giving it to the
it's been deemed all tax-free.
care provider is tax-free.
Yeah, that's a good thing.
It's a very good thing. It's an insurance product. So here's what I did.
That's a life insurance linked benefit.
That's a life insurance. Now, there's the annuity side.
I like it. Because, especially if you have an annuity that you've had for a long time.
A lot of gain.
You have it personally, and you're looking at it going, man, if I start taking money out of this, cash it in, it's going to cost me a ton in taxes. And even when I die, the money going to my kids is going to cost them a ton of taxes. And I'm worried, about this long-term care thing. Fine, let's take that annuity. Let's say it's $100,000. You put $30,000 into it in 1985, and now it's worth $100,000. I'm making up numbers. You put $100,000 into a linked benefit annuity, and it gives you $300,000. It could give you $200,000, maybe $300,000 of long-term care coverage.
That's if I need it. And if I don't need it, if I never need long-term care coverage,
if I never needed it, then it's still going to be taxable to me or taxable to my heirs. But if I do need it, I can draw it down tax-free.
Well, and that's the point. You would have been in the same situation anyway, but you covered yourself for long-term care.
You're giving up probably a little bit of future growth.
Now, since it's not an insurance policy, are the on the annuity side...
But it is an insurance policy, but it's not a death benefit.
Well, it's not a death benefit. Do you still have the same underwriting issues that you would have with a long-term care policy?
No, not as much as with the life insurance, because with the life insurance, they're looking at you both from a long-term care standpoint and a life insurance standpoint. So there's certain medical conditions that long-term care just doesn't care about, because if you have that condition, it's not going to put you into a long-term care facility. It's going to kill you. And long-term care doesn't rate that kind of thing because it's not going to affect long-term care.
Yeah.
And there's other things that will put you in a long-term care that they look at very seriously. So with the life insurance, you have to be a little bit healthier than with the annuity one. And with the annuity ones, the questions are not... Now, if you're already using a walker on oxygen and doing things like that, you're not going to get long-term care. It's too late. But if you're not, in those areas, you're not in you haven't been diagnosed with dementia, you're not using, basically using the care already, because that's not insurance. Well, that's just looking for somebody else to pay.
Of course, which is the whole point of doing this anyway. But
you're looking for somebody to pay in the event of not already happening.
Yeah, insurance companies are wise to that. So just very quickly as we wrap this up, on the life insurance portion of this, I see no reason why somebody who is not in this situation, why they wouldn't really do it. I've got $50,000 in my hypothetical example sitting in a CD. It's there to pay for long-term care or whatever cash needs that I might have. Why not take that $50,000 that's sitting in the bank and move it to an account at the insurance company? Because by doing so, I can either take the cash out after maybe a year or two of surrender if I want. I can take ownership of, maybe I want to buy a boat with it, and I can still do that. I don't care, whatever it is. All right? I would lose long-term care and life insurance, but whatever. I can do that. Or if I leave it in there, it can pay for long-term care.
Depends on age and other things, but yeah, it can leverage up nicely.
Or if I never need long-term care and I die, my relatives don't get the $50,000 that they would have gotten at the CD. They get something $80,000 or $90,000. I mean,
tax-free.
Tax-free. So why not? It would be my question. The only way you're going to find out is to talk with somebody about your individual situation. Now, we've been throwing out this hypothetical example and throwing out some of these numbers. Your numbers are going to vary depending on your situation, how old you are, your health, how much you want to put in, and all this other stuff. But that's why you need to speak with an advisor who can tell you about it. I'm going to give you the name again because I said we did have a couple people asking us about it. It's called Linked Benefit, as in linking a benefit to an insurance policy or an annuity.
Yeah, that's not a company or a specific product name. That's a style of product.
Right. It is not a name of anything other than that's what the type of, it's like term insurance. It's not the term insurance company, Term Incorporated. It's term insurance. So this would be Linked Benefit. If you want to know more about it, you can get in touch with us here. You can give us a call off the air, 800-644-1150, 800-644-1150. That's the number at Lucia Capital Group. They'll help you out. Can you qualify? Can you do it? Is it right for you, you need to find out. You can talk with Professor Rick Plum. You can also find some of this information online, various videos that we've done on it. Go to Lucia Cap, LuciaCap, LuciaCap.com. All right, we're out of time. We're going to cover more of this stuff later. Is there anything you want to add?
No, I think we did a pretty good job on that, actually.
I think you did a very good job, and I think I helped.
Okay.
All right. How's
now
that?
back to MASH.
Back to MASH. Yeah, we'll get that next time. All right, out of time. I thank you for joining us. For Professor Rick Plum and Ray Lucia Jr., I'm Johnny Dean. This is the podcast, Managing Your Financial Future. We'll talk to you again next time.
The information provided should not be considered specific tax, legal, or investment advice. It is not intended or written and cannot be used for the purpose of avoiding penalties imposed by law. You should seek independent advice from a tax professional. This material was gathered from sources believed to be reliable. Its accuracy cannot be guaranteed. No client or prospective client should assume that the presentation or any component thereof serves as the receipt of or a substitute for personalized advice from LCG or from any other investment professional. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Insurance product guarantees are subject to the claims paying ability of the issuing insurance company and are subject to their terms and conditions. Insurance products offered through Lucia Securities, LLC. California Insurance License Number 0H40817. Lucia Securities is the DBA for Lucia Insurance Services. Long-term care coverage policies and provisions may not be available in all states. Approval may be subject to the terms and conditions of the insurance company. Fixed index annuities are complex long-term investments designed for retirement purposes. Generally, returns are based on a market index and are limited such that an investor does not fully participate in market performance. Withdrawals may be subject to surrender penalties or foregoing benefits if withdrawn prior to the contract term. Withdrawals prior to age 59.5 may be subject to a 10% penalty tax in addition to income tax. Annuities are not FDIC insured. Certain terms and conditions apply. Prior to investing, discuss with your investment professional and read insurance company materials carefully. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. SSA website is at www.ssa.gov or call 800-772-1213 to speak with an SSA representative. The investment professionals are registered representatives with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. Lucia Securities, LLC was acquired by LPL Financial August 2020. The investment professionals of Lucia Securities, LLC are now affiliated with LPL Financial and are conducting business using the name Lucia Capital.